Welcome to Should I Do It, the email edition. I'm Aaron Task here with David Pelletier. David, welcome back.
Thanks for having me.
David writes our Value Investor newsletter and Dividend Stock Advisor, and also writes the weekly Should I Do It column. And every week we take your emails about stocks you want to talk about. And before we get to the emails, I want to ask you a follow-up question. Last week you talked about Amazon.com, and you had said, don't chase it. And if I was going to be flip, I would say you didn't like it at 45, you must hate it at 53 plus where it is today. But in all seriousness, did the earnings report last night change your perspective at all on Amazon.com?
Yeah, we sure nailed that one, didn't we?
Yeah, well,
that was a mistake. But when I look at it, no, the earnings report didn't change my opinion on the company. The margins were a little bit better. It was the first time the operating margin had grown in 6 quarters, but it was still by a small amount. What this was a case of, and you do need to learn from your mistakes in the market. And in this case, I underestimated the power of the short interest. Not only was there a sort of a negative tinge to Amazon, about 20% of the stock was being shorted ahead of the earnings. And you saw 4 upgrades this morning. Every single one was from sell to hold.
Wow.
So not to make light of it.
So it was a big short covering. That's a big part of the rally here. And the stock had a big run prior to this too, so you would think that the shorts were even more surprised that we've had more upside action.
Exactly. Without that short covering, the stock's up 3 today. Either way, I would, if I held it and you're up 9 points today, awesome. But I would take profits into it.
Okay, moving on. And of course, no one's perfect. And I don't mean, that wasn't a criticism. We just had to talk about it because last week we discussed it and now we're following up. All right, let's get to the emails. The first one comes from Dave, who's walking his dogs right now, or he says that's when he's listening to the podcast. It says, now that Capital One took a big hit and lowered guidance, is there any reason to pull the trigger? What are your thoughts about Capital One?
Tough call. It looks inexpensive at 10 times earnings. I think the estimates may still prove to be optimistic, though. The company has a lot more credit risk than they let on to. And so if you're going to buy this one, be ready for it to be volatile. It could go to 80 from about 73 right now, but it could go to 68. And really, I just don't see the risk rewards being favorable.
Right, and it was kind of an outlier in what has been a pretty strong season for financials, along with KeyCorp and Zions. I mean, Capital One was really one of the big misses in the financial sector,
well,
so there's probably better places to be.
Right, there's also a lot of subprime and all-day there that people didn't realize because since the company was so large, but they weren't as diversified as people thought.
Okay. Next email comes from another Dave. It's in Madison, New Jersey. He says, hi, Aaron, would you please ask David about Schering-Plough? Well, here I am asking David Pelletier about Schering-Plough. The other Dave writes, it's had a nice run and I've profited from it. I'm wondering if it's time to take my profits and replace that investment with another pharma, Bar Labs, perhaps. What are your thoughts there?
Schering has had a very nice run from the teens to about $30, and yes, I probably would be taking profits here. Of the large cap pharmas, my favorite one currently is Wyeth, WYE. They have about 5 or 6 stocks that should receive FDA approval literally within the next year or so. And at 55, I think the stock has another 10 points upside over that time.
Okay, and the big pharma stocks in general have had a big run of late. Would you be more disposed to think about maybe a biotech stock? Because that's where, like a MediImmune got a buyout from AstraZeneca, had a huge move. Are investors better off being maybe in the big biotech stocks as opposed to being in the big pharma stocks?
In biotech, I prefer to own a basket, even if it's some of the larger names, just because they are much more volatile. Wyeth trades at a discount to its peers, and unlike everyone else that needs to buy a pipeline, they already have one.
They have a pipeline, so maybe they'll be acquired.
Maybe.
All right, so final question today comes from Patrick. Any comment on Broadcom? They report this week. What's their temperature?
Honestly, if Broadcom would just stop suing Qualcomm,
everything would be okay.
I think both companies would go up, would move higher. We saw from Texas Instruments this week that maybe some bottom in this area. And again, if they kind of focus their efforts more on the core business instead of the lawsuits, the stock seems relatively inexpensive here. And the quarter's looking like it's shaping up pretty well. And the stock could move back up towards 40, assuming we have seen the bottom in this area.
And you mentioned Texas. You also had some good news from Altera. And Qualcomm reports tonight and Broadcom tomorrow. Is that right?
Yeah. The interesting thing about Qualcomm, they get about 80% of their revenue from overseas, a big weak dollar beneficiary that not really many people know that.
Okay, so that's one to keep an eye on for this week. David, thanks very much.
Thanks for having me.
I'm Aaron Task, and again, every week we'll take your emails. Our email addresses are on the screen, so send us your questions and comments and we'll tackle them next week on Should I Do It? I'm Aaron Task. Stay tuned for more of TheStreet.com TV.